So the title of today's webinar is The Oracle of Omaha, Picking Stocks Like Buffett. And we get a lot of requests for people, Buffett as one of the most famous investors of all time, perhaps the most famous. We get a lot of requests for sessions outlining some of his techniques, his investment process, what he looks for in a company, and to find ways that we can mimic his process, which has been very successful for the last 60 years. So a quick disclaimer, obviously all the information presented here to the best of our knowledge is true and accurate. However, if there is a typo or misprint, please forgive that, as we are human, and obviously consult your investment professional before investing in any online investment endeavor. So let's take a look at Buffett. This is a recent picture of him on the right. To give you a quick background on the man, born in 1930 to a U.S. congressman, so not exactly a rags to riches type story. But he bought his first stock at age 11. So bought, I think, 3 shares for himself and 2 for his sister. The stock was City Service. He bought preferred shares. And by the age 15, his sophomore year in high school, he actually bought a pinball machine. He and his friends put $25 together, bought a pinball machine. So he bought this pinball machine for $25 with a friend, convinced a barber shop to let them put it in there. And within 3 months, they had almost a dozen pinball machines in multiple barber shops. And this is, just a quick way to make money, but just kind of shows to the mindset that he's always had. He's always been looking at ways to generate cash flow from investments. And this pinball machine, it was just his first endeavor in investing. And the idea was so simple. You buy a very simple product that is used over and over, produces strong cash flow, and has very low overhead. So after high school, went to college, ended up actually getting rejected from the Harvard School of Business, but ended up going to Columbia after reading The Intelligent Investor. Wanted to study under one of his idols, Benjamin Graham and David Dodd, and from there he earned his master's in economics. At age 20, while he was still in school, now one of his best investments of all time has been Geico Insurance Company. What many people don't know is he actually got this idea from Benjamin Graham, and Graham took a big position in his partnership, actually became a board member, and upon learning this news at age 20, Buffett actually went to the Geico headquarters, knocked on the door one evening, was eventually let in by a janitor, and through that entrance actually met the current vice president, Lorimer Davidson, and is still a good friend of his to this day. But the way Davidson tells the story, he came in, was really impressed with the guy, in almost 10 minutes, sat down for hours with him talking about the business, letting him, teaching him how the insurance company operates, how that business segment works, how cash flows are generated, etc. So following college, he initially worked as a stockbroker and was humbled to teach a class entitled Investment Principles. It was a night class at the University of Nebraska, Omaha. And after a couple of years of this, ended up taking a job with Benjamin Graham's partnership in 1954, where he worked closely with Walter Schloss. So took this job, finally got the job with Graham's partnership. I believe his initial salary was something like $12,000. It sounds minimal, but in today's numbers, it's really around $112,000. But at this time, worked very closely with Walter Schloss, another super investor. Did a webinar on him before, another guy that liked to buy cheap stocks. After about 2 years into his position there, Graham actually shut down his partnership. And he did so, if you read his interviews, based essentially on boredom, in that he was buying these stocks at severe discounts to net asset value, and it just became something that was no longer challenging. So upon this, Buffett had built up a good amount of money, $174,000 at the time. Remember, he's about 26 years old. Today, that's about $1.5 million, and used that to start an investment partnership. And eventually, after the next couple of years, he was actually running 7 limited partnerships. So friends and family and co-workers would come to him and say, hey, can we set up this partnership? And a limited partnership is essentially just like a hedge fund, right? He'd take their assets, invest them for them, and take a percentage of the profits. He never charged a management fee, but took a percentage of the profits over a low hurdle rate. And by 62, he decided, this is too much to manage. I'm going to merge it all together. He had bought the textile business, Berkshire Hathaway, once, and began using the profits from that to buy stocks. Once the business ended up flopping, he kept the name and converted it into what is now one of the largest investment management firms in the country. So again, really odd, kind of an odd start to how the Berkshire Hathaway became the monster that it is today. But that's really kind of how he got started. And obviously, since '62, he's done nothing but make money, and produce fantastic returns for his investors. So let's look at his investment philosophy. We want to go over some broad strokes of it, show you some quotes from Buffett, and then kind of step down through each of the fundamental criteria that he looks for. So obviously, he believes in a margin of safety above else, right? And a margin of safety simply is how much of a discount you pay relative to what that stock is truly worth. So if it's worth $100 and you buy it at 50, you've got a 50% margin of safety, meaning even if you were off by half on all your estimates, you shouldn't lose money. He only buys top quality businesses at fair prices. Now this is very different from Buffett of the 60s and 70s, where he very often bought these cigar butt type companies. What that means is just they're trading at discount to book. Maybe it's worth $10, it's trading at $6. He'll buy it, flip it out when it gets to 10. And that his philosophy slowly changed over the next few decades, and today really operates only on high caliber companies. And he's said many times that he thinks no price is cheap enough to pay for a bad company. And it's been cited before that whether you pay $50 or $5 for a stock, if it goes to zero, you've lost the same amount of money. He does not believe in excess leverage or derivatives, and actually calls derivatives weapons of mass destruction. Now, a few notes on this. A lot of people like to say he doesn't touch options, he doesn't use leverage. It's not 100% true. Berkshire actually runs on about 1.6 times leverage, and he does use derivatives, but only in a very conservative way. The only way I've seen him use options is by selling put options. So say a stock is trading, for example, at $25 a share, and he wants to buy it at 20. So what he can do is sell a $20 put, and maybe he'll get something like $1 a share for it. And one of two things is going to happen. Either the stock will climb higher, it won't get put to him, but he'll keep the dollar, and if returned a 5% return on this, or it does go below 20, it's put to him, so he buys the stock at 20, but he collected the dollar, and he ends up being long from about $19 a share. So it's kind of a win-win situation if you're comfortable with the price and willing to buy a stock. Okay, so all this does is it's either going to give him an even better price or free cash for being willing to buy. He prefers investments that he can hold forever, and there's many quotes that his favorite holding period is forever, and you'll see that when we look at his current portfolio. He always analyzes stocks as if he were buying the entire business, and this is really important, and it's what I encourage you to do. Instead of trying to break things down on a per share basis or start to think, well, Goldman's going to take up positions, that might push the stock here. Forget that the stock market even exists, and just analyze it as if you had the cash and you're going to buy the entire business. It's something you would want to own for the next decade or 2 decades. If it's not, then it's probably not a stock you should buy. And that's really the best way to approach it. And he said many times that he's only going to own things that if the stock market were to shut down for 5 years, he'd still be comfortable holding those. So forget that we have this liquid access to get in and out of investments. Just assume you're buying the whole thing. And then finally, buys only when the price is at a discount to that intrinsic value. And that's really the idea of the margin of safety. The bigger discount he gets based on what he feels that company is worth, the larger this margin of safety is. So what he's used a lot, he calls it the 4 filters method. Now it's not a hard formula where you plug in a couple of pieces of data and it gives you an exact price of what to pay and where to sell. But these are the 4 sort of pillars of his investment philosophy. And he says, we select our marketable equity securities much the same way we would evaluate a business for acquisition in its entirety. So the same thing, right? We're looking as if we're going to buy the whole company. We want business to be one that we can understand, 2, with favorable long-term prospects, 3, operated by honest and competent people, and 4, available at a very attractive price. So these are his 4 pillars here. A simple, to understand business. Favorable long-term economics. In other words, is this a product that is not going to be relevant in a couple of years? Is this a company whose margins are declining? Or is this a market leader who we feel will continue to not only maintain its market-leading position, but also grow it and increase revenues? Able and trustworthy management. Now, he has better access to company managements than you and I do, right? He can get a sit down with pretty much anybody in the business world. But there's other ways to analyze able and trustworthy management, right? You can look at the cash flow statement. What are they doing with their profits? Are they buying back shares? Are they paying out excess cash and dividends? Or are they kind of blowing it on maybe poorly analyzed acquisitions? Are they issuing more stock to raise money and diluting current shareholders? Are they setting up sweetheart deals with other companies that other executives own? And finally, offers a margin of safety, right? Everything comes down to price. Every penny of profit or loss that we experience is a direct result of the price we paid. And no matter how good the business is, there is always a reasonable price to pay, and one that does not make sense from an investment standpoint. So a few quotes from Mr. Buffett to kind of summarize the way he approaches the market. When it comes to his philosophy, he said that I'm 15% Fisher and 85% Ben Graham. So Benjamin Graham is very much a deep value guy, right? High margin of safety. What's the worth book? He's only concerned with what he can lose and look at the downside. Very much the godfather of deep value. And the other 15% is Phil Fisher. And if you've never read Phil Fisher, he's got some books out there. Buffett recommends them heavily. Fisher is a very thorough investor, to say the least. I mean, it's a guy who, uses what he calls the scuttlebutt method and talks to suppliers and distributors and other people in the industry. But that's kind of how he bases his philosophy on. And he said the basic ideas of investing are to look at stocks as a business, use the market's fluctuations to your advantage, and seek a margin of safety. That's what Ben Graham taught us. 100 years from now, they will still be the cornerstones of investing. Be fearful when others are greedy, and greedy when others are fearful. And risk comes from not knowing what you're doing. And this was really a direct, it was an answer to someone asking about diversification, talking about having a concentrated portfolio being more risky. And Buffett is strong to the sense that, look, I don't care if you only hold 5 stocks. The risk comes from not knowing what you're doing, paying too much for a company, buying bad businesses, not from owning too few. And then finally, one that kind of pertains to today is you never know who's swimming naked until the tide comes out. And what he was referring to with that is, firms and investors that use excess leverage and pay really high prices for stocks. If you look back to the tech bubble, if you look back to '08, it's with the real estate bubble, and a lot of really, in my opinion, these social media companies today, people that are investing in those are very happy and feel pretty good about themselves, but as he says, once the reckoning kind of comes and prices reevaluate, then you'll really see who knew what they were doing and who didn't. So one theme with Buffett, and our job, obviously as investors, is to do our best to analyze businesses, to put a price on them that we can buy at a discount. And so Buffett uses something called owner earnings. I got a lot of questions on this, so I wanted to show you what it is, as Buffett explained it in a shareholder letter in 2011, and kind of give you that basic formula. So, as a direct quote from the shareholder letter, Buffett says, owner earnings represent reported earnings plus depreciation, depletion, amortization, and other non-cash charges, less the average annual amount of capital expenditures for plant and equipment that the business requires to fully maintain its long-term competitive position and its unit volume. Okay, so let me lay this out for you, and just put what we just put there. This is that formula. And it's very similar to free cash flow with one main difference. And a lot of people use free cash flow instead, mainly because it's simpler, it's easier to find, and you can program you can program the data to produce that figure for you. Like you've got free cash flow on the Guru Focus website. You cannot program a computer to give you the owner earnings figure because of this average maintenance capex figure right here. Okay, so that's capital expenditures, which is what a business spends of their cash to both maintain equipment and also buy new and expand that business. So if you take the net income, right, the earnings per share, add back in the depreciation, amortization, and all, and the other non-cash items, and then take out the average maintenance capital expenditures, that is the owner earnings figure. The problem is that the capital expenditures line may be 1 million one year, and then 5, and then 2, and then 3, and then 21, and then 11. And what you have to do is find just the maintenance section of this. So somehow read through the company filings and decide how much of this was spent for expansion or to increase production size, going to produce more cash flow, and how much of these annual figures is needed to maintain equipment and continue operations. Because that's the big thing that net income does not include. And if a company makes $100 million a year, but it costs $95 million to maintain and service the equipment, there's not really much left for an owner. So that's why I use this owner earnings formula. Now, Carl's asking, doesn't he also use the two-column valuation method? So, Carl, the two-column valuation method is in no way a replacement of this. I'll show you what that is. And I made this slide for you. So what he was referencing when he mentioned the two-column valuation method was how to value Berkshire Hathaway or other large holding companies. Okay, so Berkshire has a lot of things. It does a lot of stock investments, and it also owns a lot of businesses outright that were once public, or maybe they were private. He bought them. They're now in the portfolio. So since they're no longer publicly traded companies, how do you value those and try to put a figure on what Berkshire is worth? So this is his two-column valuation method. Okay, these are just figurative numbers. They're pretty close, but they're not exact, just to give you an example. And his two columns are this: the per share investments and the per share earnings before interest and taxes. All right, so he takes, on a per share basis for Berkshire Hathaway, how much stock is there per share, what is it worth today? And then he looks at, of all the businesses that Berkshire owns, taking their total EBIT, their total earnings before interest, dividing by the number of shares, how much earnings are there coming into Berkshire? From there, he just looks at, where is the market trading? Is it trading at 10 times EBIT? Is it trading at 11 times EBIT? 12 times? Takes that average figure, which is somewhere around 10, and multiplies it to get the per share EBIT value. Okay, so if the companies they own are earning around $6,000 a year, most stocks in the market are trading at about 10 times EBIT, then those businesses should be worth about $60,000 per share. And I'll just give you another example, 2011. So then all he's doing is adding the investments, the per share investments here, plus the business value to get this intrinsic value. So in the 2010 example, it would be the 95,000 plus 60,000. It says 65, should be 60,000 to produce about $155,000 per share. Okay, so hopefully that kind of straightens it out for you, Carl. That's what he's referring to as two-column valuation method. It's just, how do you put a figure on Berkshire? How do you know what it's worth? When to buy back stock? And this is what he's talking about. Correct, Carl. Yeah, this is not something you use to evaluate individual stocks. So let's go through a checklist, and this is based on the writings of Buffett between shareholder letters and interviews he's given. Let's go through some of his big things he looks for in pertaining to stock and equity investments. First, we touched on earlier, is the business simple and understandable? He said an investor needs to do very few things right as long as he or she avoids big mistakes. And one of the biggest mistakes you can get into is buying into a business you don't understand, only to see huge losses. And if you talk to some Enron investors and you talk to some others that bought into these dot-coms that they didn't really understand what they did, they'll tell you how devastating some of those losses can be. So, above average returns are generally produced by doing very ordinary things but exceptionally well. You don't have to find the next great technology. You don't have to, be on the cutting edge and understand, where telecom is going and make the right play there. Just be disciplined and buy understandable things, but do it rationally at good prices. Does the business have a consistent operating history? And Buffett's experience has been that the best returns are achieved by companies that have been producing the same product or service for several years. So this goes back to his holding period being as long, forever, if is his preference. And getting into IPOs or stocks that have been maybe profitable for a year or two is a lot more risky than buying a Wells Fargo or a Coca-Cola or some of these firms that have 10, 15, 20-year track records. Third, is the business of favorable long-term prospects. Okay, so Buffett sees the economic world as being divided into two types of businesses, and he calls them franchise and commodity businesses. And franchise, he's defined this as a company that provides a product or service that is needed and desired, has no close substitute, and is not regulated. So he then looks for the franchise businesses. So think about the big stocks he owned. Think about the Afflecks and the Coca-Colas and the Geicos and the Coca-Colas and the Wells Fargos and the Procter and Gamble's. I mean, what are they all offering? They're offering banking and services and soft drinks and these products that people want. Most have no close substitute. Maybe Wells Fargo does, but if you look at like a Coca-Cola or some of the others, I mean, very few people are going to pass on Coke and say, oh, Pepsi's 20 cents cheaper. And third is not heavily regulated. Fourth, is management candid with shareholders? He's quoted as saying, what needs to be reported is data, whether GAAP, non-GAAP, or extra GAAP, that helps the financially literate readers answer three key questions. One, approximately how much is the company worth? Two, what is the likelihood that it can meet its future obligations? And third, how good a job are its managers doing given the hand they've been dealt? The CEO who misleads others in public may eventually mislead himself in private. So he's just looking at, when he reads these statements, what happens when they have a good year? What happens when they have a bad year? Are they very conservative with their estimates? Are they letting shareholders know when they're lowering guidance they don't think they're going to meet expectations? Or are they guys that really overhype their product and what they think the year's going to be? Are they raising a lot of capital as quick as they can and issuing more stock when valuations are rich? Just kind of looking at the actions of management to decide how open and honest they're being. Does management resist the institutional imperative? According to Buffett, the institutional imperative exists when A, an institution resists any change in its current direction. Just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up available funds. Any business that's craving the leader, however foolish, will quickly be supported by detailed rate of return and strategic studies prepared for his troops. And the behavior of peer companies, whether they're expanding, acquiring, staffing, etc., will be mindlessly imitated. So what he's saying is, are these companies, are they just following the herd, right? And I think about the cable companies when I hear this, right? They're very slow to change their direction using the same old model, even though we've got Netflixes and Amazons and all these other competitors really shaking up the environment, talking about how when they introduce a product that their employees just mindlessly say, yeah, it'll work. A lot of yes men. When other companies are expanding, they're expanding. When other companies are compressing, they're compressing. Just following what the rest of the industry is doing. Is focused on return on equity. So the primary test of managerial economic performance is the achievement of a high earnings rate on equity capital employed, without undue leverage, accounting gimmickry, etc., and not the consistent gains in earnings per share. So what he's looking for is not what are these fluff numbers that are being pumped out on Wall Street, but what are you returning on the money you have, right? What are you taking the assets that investors have entrusted with you with that company and using them to produce additional capital? That should really be the focus, not what the number comes out at each year. And then what is the rate of owner earnings? He prefers to modify the cash flows we mentioned earlier to that owner earnings number. And while they're not precise, calculating future capital expenditures requires some rough estimates. So this is the figure that he's using. And we talked about the formula to do that and how to go about it, but he's looking for cash generators, okay? And if you look at a company like Amazon, which is a wonderful company, it's not one you're going to see Buffett buy, because they're taking all their earnings and they're putting it back into the company to expand and grow and increase. And a lot of people some people prefer to invest that way today. A lot of these growth investors, they want a company to go from 10 million to 10 billion inside of 5 years. But Buffett really prefers businesses that are just ATM machines and pump out cash, a lot like those pinball machines he was buying at 15. You put in a small investment, let it work, and it just generates cash and generates cash and generates cash. So Carl's asking, some say Buffett looks more at high return on equity history, while others say he looks for more of a high return on capital history. What do you find is most true? Carl, I mean, I don't think Buffett's using traditional metrics. It's just a hard line number. But he's just getting kind of a ballpark figure on what that company has, the total equity there, without using leverage and without using excessive debt, and what are they able to produce with it. So along those same lines, the type of businesses that he prefers, is it a high profit margin company? And in Buffett's experience, managers of high cost operations continually add to overhead, whereas managers of low cost operations are always finding ways to cut expenses. Berkshire Hathaway, for example, is a very low-cost operation. It's after-tax overhead corporate expense of less than 1% of operating earnings. Compare that to companies with similar earnings, but 10% corporate expenses. So he's just talking about low-cost guys tend to try to be more low-cost. High-cost guys tend to just get higher costs. So think about high-cost operations. If you're looking at gold miners, you're looking at coal companies, you're looking at business in the automakers and companies that have just huge high overhead expenses in order to produce a product. And generally, it becomes, if you think about an automaker, there's going to be more regulation, there's going to be more safety checks, there's going to be more features added to cars, and those expenses become higher and higher and higher and higher as the staff increases and the warehouses and the plants and production facilities increase. However, when you look at just a cash-generating, easy, simple business, they're always looking for ways, instead of making things more complicated, make them simpler, cut costs even further, increase the profits that are available to shareholders. And has the company created at least $1 of market value for every dollar retained? And Buffett explained in a quote, "Within this gigantic stock market auction arena, it is our job to select a business with economic characteristics allowing each dollar of retained earnings to be translated into at least $1 of market value." So what he's looking at is just, what are they doing with the cash? And we've talked about this in several other points this afternoon, but what are they doing with the money? Okay, if there's earnings for the company, as a shareholder, I'm entitled to my share. If they're going to keep them, what are they doing with them? Are they taking that dollar in profits, investing it to expand operations in order to produce $1.50 or $2 in profit? And if instead the cash that is being retained by that company, the profits they're holding on to, is being spent on expansions, diversifications, and used for purposes that do not return additional capital for shareholders, that's wasting money, and they'd be better off paying it out as dividends. And finally, what is the value of the business, right? Price established by the stock market. Buffett tells us the value of a business is determined by the net cash flows expected to occur over the life of the business, discounted at an appropriate interest rate. He used to use the long-term U.S. government bond rate, but it also used to be a lot higher. So I'm not sure exactly what he's using today, but probably substituting with a minimum rate of return. And this is, the discount cash flow. And this is one of the tools we've got on GuruFocus.com. It's looking at, we use cash flow to do it precisely as Buffett. You'd probably want to use the owner earnings figure if you can calculate that. And it's projecting what it's going to earn over the next 20 years, and what is that sum of money worth to me today, assuming I'm going to achieve a decent rate of return. And once you've got that figure, can it be purchased at a significant discount to its value? Okay, once you've put a value in that business, Buffett then builds in a minimum margin of safety, and then only buys at prices far below their indicated value. So he does all the work, he finds the owner earnings. He does his homework to decide what he thinks it can reasonably grow at going forward. He does the math to figure, okay, if my expectations are it's going to make, X number of dollars going out the next 20 years, and I discount those back to what I think it's worth today, I get a figure of, say, $100 a share. And he may want at least a 25% margin of safety, so he'll say, all right, if this thing is below $75, I'm going to buy. And it's just that simple. The concept is very basic and very simple. It's the application that becomes difficult, and like anything else, if it's worth pursuing, it is going to require a little bit of work. And everyone wants someone to come on here and say A plus B equals C, this is Buffett's formula. Plug in these figures into a spreadsheet and it'll give you a buy price. But it's not that simple. And there are hundreds, if not thousands, of people who've tried to do that for the last 50 years and none have been successful. So let's take a look at some of Buffett's stocks today and see what he's holding. And we'll take a look to see if these stocks are meeting the criteria that we outlined. So at his current portfolio, last updated in March of 2014, what I like to do here is to filter this down by weighting. So I want to see his largest holdings. So if I filter that, I'm immediately seeing the stocks that he owns the most of, that have the most conviction. And his big holdings, his top 5, are right here. Wells Fargo, Coca-Cola, American Express, IBM, and Walmart. There's actually a phantom one in there as well. Bank of America, which is not shown. He owns a huge amount of warrants in this company. What warrants are, they're very similar to call options, and he kind of bailed the company out in 2009, infused a bunch of capital, and in addition to getting preferred shares at a ridiculously high dividend yield, he also got a bunch of warrants giving the right to buy that stock anytime until something like 2018. So those warrants, if converted, would be about his third largest holding. And of these companies, I mean, we're not seeing any surprises, right? We're seeing the absolute most high-quality company in each of these groups. Computers, retail, food and beverage, banking. Procter & Gamble would be, household goods and essentially everything. ExxonMobil in the energy sector. U.S. Bancorp, another bank. DirecTV. We're getting absolute top caliber companies. We're getting those that have the widest moats, that are at least apparently in no immediate danger of having their market share wiped out, or erased or eroded. So the threat of competition beating them out on price is minimal. When we look at their financials, they all have some of the best fundamentals in that sector, including minimal debt, not issuing stock, preferably buying shares back, high rates of return on equity and capital. And you're going to find this in most of his holdings. Now, we've tried to mimic this process as best as is computerly possible with something we call the Buffett-Munger screener. And this has been a really, really great performer. If we look at the performance of this since its inception in 2009, you can see that it's outperformed the S&P by about 18%. And the only losing year, actually this year, surprisingly, it's down 0.3%. So essentially it's pretty flat. But it has beat the market almost every year. It's barely trailed by 1% the last two. And returned 135% since inception. So pretty good considering it's only about 5 years. And what this screener does is try to mimic his process through the following fundamentals. And we're first looking for companies that have a high predictability rank. Okay, and that's our custom algorithm that scans for the consistency of a company's revenue and EBITDA. Buffett very much favors companies with long, consistent track records. He likes, high-quality companies, which the 4 and 5-star tends to be. And so that's going to satisfy one rank there. He likes those that have competitive advantages, or a moat, as he's coined. And so we use profit margins to identify these. If a company can grow its business while maintaining or expanding its profit margin, the odds are it has a moat, right? What happens if you're a newcomer and you're very successful? A lot of other companies come in and compete with you. They want a piece of the market, and they're going to fight you on price. And to stay competitive, you've got to lower your prices to either maintain or grow the business. However, if you can continue to grow without having to reduce prices and maintain or increase your profit margin, the odds are you have a moat or a strategic advantage in that business. Third, we're looking for companies that incur little debt while growing the business. So, it doesn't count to keep your profit margins high and to continue to grow if you're just borrowing a bunch of money to fill the holes. So we're looking at minimal debt for several reasons. One is what I just mentioned. The second, a company cannot go bankrupt if it has no debt. It's just not possible. So debt is always a hindrance. It's going to be a hindrance on earnings and owner earnings and net income. It creates liabilities that can have unexpected ramifications on the business. So the less debt, the better. And then finally, we're looking at companies that are fairly valued, right? Buffett's all about the price you pay. So we're using the PEG ratio to determine fair or undervalued prices, and using the PEG, just the earnings multiple, the PE over the growth rate, 5-year EBITDA, and if it's trading at an earnings multiple less than the rate it's growing, it's generally a pretty good price. If it's trading above that, it's probably fair or overpriced. And so combining all these metrics, we've been able to build this screener, and as of today, it's got about 60 stocks on it. The performance track record you saw assumed rebalancing only once per year. So assuming the first trading day in January of each year, it takes the top 25 stocks from this list, buys them at the opening prices, and then holds them for 365 days and does so again. This list will update on a daily basis for you, depending on if company fundamentals change or stock prices move. You can also look for Buffett Munger stocks, not only in the U.S., but in any region that you're subscribed. And so you see kind of the number of stocks that show up in each of these. We're seeing a lot of value in Europe with 93 stocks, 35 in Asia, only one in Oceania, which is Australia and the southeast region there, 4 in Canada, and of course 60 here in the U.S. So you can filter these down further. I mean, if you only want maybe large cap stocks, you can filter it down to that and get 28. If you only want giant and mega cap stocks, well, none are actually filling that number there. If you're only looking for smaller cap companies, you can filter this down. So by market cap, by country, by sector, you can go ahead and remove the over-the-counter stocks here, and it looks like there weren't any in it anyway. And then if you want really, really high predictability, and these are already down to 4 and 5 star, but if you only want 5-star companies, you can do that and find what's showing up. And so we're seeing Deere & Company, we're seeing Portfolio Recovery Associates, VMI, Valmont's a company that we own here, PetSmart, another fantastic company, and a handful of others. So this screener is really designed to take a lot of this work out of it for you. But if you still want to do your own homework, I would suggest using that owner earnings formula and then applying it to the discount cash flow valuation. All right, so let's take a company, let's say Apple, for instance. And here's what you would look at. So you take the company's net income figure, which in this case, for the most recent 12 months, is $37.7 billion. You would add back in the following figures. You'd add back in depreciation, depletion, other operating charges. You would get a figure of what, around 45 billion from that. And then you want to remove capital expenditures. Okay, so what are their average capital expenditures? To be found on the cash flow statement. It's going to show up as purchase of property, plant, and equipment. So here's this line item right here, and this is the capital expenditures. So you see it's pretty variable. and you're trying to find the average maintenance capex here. So, what I'm seeing around 4.2, 8.3, 8, around 7. So, it looks like at least the last 2.5, 3 years, it's been between 7.2 and 8.3 billion. So to be safe, we could say it's $8 billion. All right, so if we take the 45 billion, add back in the capex of 8, or excuse me, take out the capex of 8, we've got a figure of around $37 billion. So you divide 37 by this number of shares outstanding, 6.62, so let's just do that real quick. Let's get about $5.68 a share in owner earnings. All right. And by coincidence, it's the same figure as the earnings here. Now, once you've got that, your quest is to determine what can this company grow at for the next 10 years. All right, the next 10 years, what are we expecting it to grow at? I don't think it's going to grow at 20% a year. But say you think it's going to grow at around 7% a year. Or maybe you think it's going to grow at 9% a year. Whatever that figure is, that's your growth rate for the next 10 years. Then you've got a terminal growth rate. What do you think it's going to slow down to after a decade? And then you apply your discount rate. So what do you want to discount these values back at? Now, we're using a very aggressive 12%. What that means is you're going to get a much lower fair value figure to add in more safety. If you used something like the long-term government bond rate, which can't be but what, maybe 4% or so, you get a very high value. If you use more like 9%, you get a number something like this. So it just depends on how well you can calculate this stuff, and I encourage you to be as conservative as possible. And when you put all these things together, you get a fair value for that stock, or a rough intrinsic value. And then you have to say, okay, if it's worth $88 to me, I need at least a 25% margin of safety. It's a great company. We need at least 25%. So if you've got $88 a share and you only want to pay 75% of that, your buy point is $66. And that's what Buffett would buy. Does that make sense? So again, it's not a clean, easy formula that just gives a buy or sell number. It's not a red light, green light system. I mean, it's Warren Buffett. He's one of the best, and the reason he's one of the best is that he fully understands businesses. He understands how cash moves through a company, and he knows that these are the types of businesses that he wants to own and that produce the best cash flow and the best long-term returns. Now, for those of you who answered that you were not a current Guru Focus member, I'd encourage you to take a trial. If you want to try out the Buffett Munger screener, you want to run some of these back tests and do the discount cash flows. Some of these features are available for free, as you know, but premium members have a whole lot more and access to all of our value strategies, real-time Guru trades, the best fundamental stock screener on the market today, advanced research tools, the interactive charts, which are phenomenal, and several other things. So if you sign up, we offer a free 7-day trial because we want you to try this out, put it through the paces, decide if it's something that you're going to use and value, and if not, cancel and owe nothing. But we believe firmly in the value of our product and know that you will too once you have the ability to test it out. Now, if you're already a member, I showed you that the screener can also scan for the same caliber stocks in other countries. Anything available on this site, whether it's Guru Trades or Value Screeners, the all-in-one screener, Inside Activity, everything can be applied to foreign markets as well in the exact same manner. Just check the country box that you want to scan for. So if you live internationally or you're an international investor, you can add these other regions for a small add-on fee. And like anything else, it's a 7-day trial. So if you're already premium, say, I want to try out, see what's in Europe for a few days, Tack it on. It's a 7-day trial. If you decide to cancel the Europe portion, you won't be charged for it. You can add and drop regions at any time. So if you're subscribed to Europe and you think, man, I kind of want to check out Asia, you cancel Europe, switch over to Asia. We'll prorate it all out. If you cancel mid-membership, we can prorate the amount of the global. So you really have no risk with this. We just want you to be free to use this as you see fit and to switch back and forth. But no, you cannot subscribe only to the Global Net letter. No, it's part of the membership. So that's my sales pitch on the membership. I encourage you to sign up, test it out, see if it's for you. It's really the only way to get a better understanding of Guru Focus and the products we offer, and put some of these tools to use for you. We appreciate all of you attending here on the Warren Buffett webinar. If you have any questions, definitely feel free to email us at support@gurufocus.com. We're always making additional site improvements based on what you guys request, and if you have a request for a future webinar, we're definitely all ears for that as well. Hope you all have a wonderful trading day, and we look forward to seeing you on the next webinar.